Hello, everyone. Welcome to the MIT Center for Real Estate podcast. My name is Sam Jakshtis, a current student here at the MSRED program. I am joined by a visionary in the industry, Dave Burt. Dave is a founder and CEO of DeltaTerra Capital, which provides the tools, data, and resources for the real estate capital markets to measure and manage financial risk related to climate change. Dave, thank you for joining us.
Happy to be here. Thanks for having me, Sam.
Awesome. This is particularly special, not only because of the work you do, but you're also an MIT alum, correct?
Sure am. That's right. Course 18, class of 97.
That's amazing. Could you, on a broad scale, could you kind of walk through the genesis of DeltaTerra Capital? You can kind of start as early as you want. What was the idea? How did your career progress to DeltaTerra?
Yeah, sure. So I spent most of my career up until launching DeltaTerra as an investor in real estate capital markets, mostly on the mortgage credit side and mostly in the securitized mortgage credit arena. I started out in pure research at a firm called Property and Portfolio Research in 1997. We were one of the initial attempts at bringing more modern portfolio theory techniques to managing institutional real estate portfolios, cross-quadrant and public, private, residential, and commercial, as well as both on the equity side and the debt side. And being an MIT math major, I certainly got myself into the most complex parts of that research, which were a growing part of the debt markets called commercial mortgage-backed securities, or CMBS. And essentially, I ended up going to work for a client who was looking at building out the same type of disciplined risk analysis that I had been performing for them as a consultant at PPR into a new growing part of the mortgage credit markets and residential. And of course, looking back, it was a difficult moment for my industry's history because a lot of that work was being driven by the advent of the subprime mortgage and the collateralized debt obligation, which of course ended pretty poorly. I have had a long career managing portfolios since then. State Street Research and Management is where we came up with the concept for a credit default swap for managing credit risk long short in mortgage credit space. That was in 2004. ISDA standardized the contracts in 2005, and we were actually purchased by BlackRock. And I've also managed portfolios at BlueMountain Capital and most recently at Wellington Management. So over the course of my career, the objective has always been to identify the holy grail of investing called alpha. And that's a way of buying low and selling high in such a way that enhances portfolio returns regardless of objective. And the main technique that I've applied for doing that is doing deep study of markets, fundamentals, and developing a crisp understanding of how a nuance changed in the sort of intrinsic values of real estate value. So fundamentals, what creates cash flows, what drives rents and risk premiums, and then applying thoughts about how things might change in the real world to how they ultimately get reflected in the pricing of a particular tranche in a securitization. So that's really been my whole career, and it was in 2015 that the IPCC released its first big public simulation data set called CMIT-5. And my team and I really got to work trying to understand if temperatures continued to warm based on the trajectories that were coming out of the scientific community. What did that mean for property liability? And basically that dwarfed everything else we were looking at in terms of mispricing of real estate that could generate alpha opportunities, and became all consuming. And it was really 2017 where you had the Harvey, Irma, Maria trifecta that finally kind of created some wider spreads and for a minute, and really got us thinking about, well, how do we actually accelerate markets' understanding of this, A, and B, there was a total dearth of investors out there willing to speculate in these markets based on what we thought were pretty inevitable repricing outcomes.
Amazing. And you didn't see prior, I mean, with all the work that you had done, was a lot of the underwriting factoring in these climate risks? And a lot of them are probabilistic, so they don't necessarily fit nicely. They're not a nice little present under the tree. It's these they can be very scary. They could be kind of all systems as normal, or how are systems factoring these in prior to your work?
Well, there's a huge amount of just uncertainty whenever you're looking at an investment and a piece of real estate. A lot of things can change about the economy, about the costs of supporting the asset, about people's preferences, et cetera, et cetera. So it's really just one factor in the midst of that. It just happens to be the biggest factor these days. And, I think people haven't had to factor it in before. And that's because the markets have remained fairly inefficient about pricing this risk. And so the only real mechanism in credit markets for managing the risk of catastrophe is insurance. And historically, insurance costs and availability have stayed pretty static, even following severe weather events. And we just think that that's because following an event in the past, you could still get a cheap NFIP policy afterwards. And you could still get a loan from Fannie or Freddie or your favorite lender without any additional scrutiny around climate. So nothing actually changed about the market's perception about the long-term carrying costs of property. That's what's really been changing recently. And it was true that in the past, because property values stayed stable after events, typically government assistance, insurance was enough to allow disturbances after events, and you do see big delinquency spikes after every major hurricane event. But those were transient. Ultimately, the damages could be paid for, and that was a one-year expense. And again, didn't really change anything about the long-term value of the properties or the long-term credit risk of the loans created against them.
So unfortunately, you kind of said the magic word, and I'm going to have to dive a little bit deeper into insurance right now. And
sure.
As you said, it's been static for so many years, and really in the last couple, it's not necessarily changed, but fallen off a cliff. And now there's places that can't even get insurance. So when you're providing your analyses, you can't just factor in just the climate change, but also the feasibility in terms of data of being able to get an insurance policy, which is required in most contexts. So, I mean, in a broad sense, how does that impact your work? And then how do you see insurance changing and adapting in itself?
The risk is there. It's interesting. We're all focused on insurance, and the insurance industry as being the focal point of this problem. Ultimately, insurance is just a risk transfer tool, right? They take the risk off the property owner. They pool it with a whole bunch of other risks, and as long as the collections on that are enough to carry the costs associated with idiosyncratic events in that portfolio, then you're good. From a property perspective, when a property is valued or purchased, you're actually valuing an infinite time series of future revenue and liabilities. I'm talking to real estate people here, and I guessing most of your podcast listeners understand the concept of an NOI over a cap
Yes.
rate.
Yep.
So what our task has really been is to say, okay, given what's actually happening in insurance, in insurance markets and the disruptions that are occurring there, how are people's expectations for that NOI liability? So, right, if insurance goes up, the net income associated with a property goes down, and that obviously affects property value. How is that actually playing out, and how is that likely to play out as insurance markets catch up to the new physical reality, part of which has just been obfuscated through subsidies and somewhat inefficient insurance systems around certain hazards over decades, and some of it is just that we've reached some tipping points.
Mm-hmm.
I think where that you sort of went past that point of where pooling a premium and diversifying it was enough to cover the increasing risks at an aggregate level. So the big catalyst that we've seen over the last few years in particular is the National Flood Insurance Program, after having to consistently borrow from the Treasury after events where it hadn't been collecting enough premiums to cover losses, completely revised its pricing framework in 2021. That was a very big change. And that was an initiative called Risk Rating 2.0. So there's a lot of information about there. We could get into it. And then the other thing, of course, were the streak of wildfires in 2017 and 2018, which just those 2 years of damages in California, I think, caused enough insured losses to wipe out 20 years plus of profits that they'd made in the state. So that completely changed the way that insurers were thinking about how much wildfire risk has really increased just over the last 1.5 degrees of warming. So those two events that I think have really made this something that the insurance industry, or sorry, the insurance systems had to deal with. And now we're starting to feel the repercussions throughout the whole system.
Do you see that there's still, I mean, as you said, it's not really all systems as normal. Do you see pretty cataclysmic changes with this? So I'm thinking, if I want to go buy a house in California and I need to get a loan, but the bank won't provide a loan without an insurance policy, and I can't get an insurance policy, I mean, are your clients seeing that there's opportunity because they could own and rent, or is it really, far gone because in 10 years they know it's just going to be so impossible to even have a house there? What are you seeing? And then just still on kind of the insurance tangible.
Yeah, so I would say, there's a theoretical view of where these things should go, and maybe it helps to speak to that. And then there's where are we on sort of the trajectory to that. And so, like I described, you did mention something else I should get to, which is credit availability, because the cost is still there when you self-insure. It's just kind of hidden, but it should be there when that property is being considered by the next buyer. So there's just but sucking leverage out of a market is obviously detrimental for prices, and risk premium needs to go up in those markets. So anyways, all that aside, you can intrinsically decide how much property value should decline given an expectation for the change in this liability. And say you were a single family rental investor. You bought a $500,000 house that had net income, so right, rents minus taxes, insurance, liability, and it had net income of $25,000 a year. So that's a 5% cap rate, right? That's a typical trade for a single family rental investor. Now you stick that home with a new $5,000 a year mandatory flood insurance premium. It's $5,000, not just once that year and every year in the future. The utility of that property is now, the NOI is now not 25,000, it's 20,000. And to get that same 5% yield, you're going to pay 400 for that property, not 500. And so that's kind of the way we do it. I mean, additionally, what actually happens in markets, of course, markets are actually determined by buyers and sellers, not some theoretical NOI over cap rate. What actually happens is the impact ends up being greater than that. A buyer who's seeing those types of changes in asset costs will assume accurately that those costs are probably going to go up again in the future, and they'll also demand a higher cap rate. Right? They'll increase their risk premium spread. So that's how we model it, and then watching how it's actually playing out in markets is, we saw listings growth really spike in particularly Western Florida, but almost everywhere that is being exposed to these new flood premiums, and where that's becoming like broadly recognized. Also in California later, so that was like in 2022. And then in 2023, when all the moratoriums around non-renewal in California started expiring, you started to see that in California markets as well, that were many homeowners were having to go pay the much more expensive rates under the California Fair Plan. So the listings growth really took off in 2022, and now you are starting to see underperformance from a price appreciation perspective in these markets. And we're kind of tracking 30-40% of our base case so far, but things are accelerating every time we refresh the data. The underperformance in these markets becomes more marked.
That's pretty interesting, because actually I was going to talk about Florida, and obviously the cumulative listings have shot through the roof and had an effect on pricing, but that's kind of bifurcated from actually, if you think of California, there's been some higher listings that have been noted for the Pacific Palisades of people buying these lots. Same thing happened in Hawaii. People were knocking at the door before, the embers were cooled. I actually had a family member who was in Red Hook in New York City after Sandy. And a very famous real estate investor on Shark Tank might have gone through and bought the entire neighborhood after, and kind of performed these arbitrage situations because they knew it was kind of this very short-term distress, but then the pricing will go back up. And how do you model that? Like, how do you incorporate that into? There's a Bayesian model that could do that.
Yeah, I mean, a lot of it is just looking at prior repricing cycles. It's like when everyone understood that foot traffic at regional malls was going to go completely through the floor, right? You had a 5-year cycle really from 2014 to 19, and of course, when subprime got sucked out of the lending landscape, you also had kind of a 5-year revaluation cycle of like, well, what is the real level of demand? So, I mean, these things certainly take time. I would say that, that playbook it's like one of the top 3 strategies for a fix and flipper is to go in after a disaster and buy the costs. And so, but again, I think what's very different now, and that the person who bought that community that you were talking about after Sandy, right? They're going to say, well, before nothing had changed about the ongoing liability for those properties after Sandy. Nothing. In fact, the National Flood Insurance Program only charges a significantly increased rate after 5 flooding episodes. It becomes a severe repetitive flooding property. And so it just doesn't really, so you got a few more properties falling into that after that event, but it's not like a systemic change. And so those liabilities, again, they just hadn't really changed. I think, if Sandy were to happen today, whoever was buying that property would be saying, wow, how do my flood premiums look? Am I going to need to get that for leverage? Yes. And, and is that likely to keep increasing as a liability? And how's that going to compare to the power I have to increase rents to keep up with that? And that will weigh on that investment strategy.
So you've touched on so many different variables that go into your analysis. I kind of want to go into the analysis itself. Now, I think we could get super technical. I'm going to try not to, but from a high level view, can you provide some types of the variables? What climate, financial? I mean, I'm sure there's so many, and I think we talked about this. There could be some overfitting in different markets if you provide too many, but you also want to optimize and provide the most accurate predictions. So just from a high level, what does your analyses look like? What are people and investors looking for from DeltaTerra?
Yeah, I mean, there's key things. So again, it's what's going to affect a borrower's ability to keep paying their loan. So there's two things you look at when you're a mortgage credit risk taker. It's borrower ability to pay and borrower what they call willingness to pay, which is kind of a negative way of looking at it. But it's essentially how much equity do they have in the home? Because if someone has a $500,000 house and they've got a $250,000 mortgage, and they run into some problem, some disruption, maybe a disaster event, maybe they lost their job or get furloughed or whatever it is. That person who's got that $250,000 in equity, they're not going to default. They're going to they have the flexibility because of that equity to find their way out of that problem and to cure. If they put down 20%, the ADLTV on a $500,000 house. But now, because that house got stuck with an additional $5,000 flood liability, that house is now valued at $400,000. They've lost all their equity. And if they run into a problem, and there's a lot of problems potentially down the road related to these ongoing issues with catastrophe risk also, they're going to be far, far more incentivized to walk away from their loan. And in fact, that's right. All that happens in a foreclosure is you get a 7-year dinger on how easy it is to get credit. Not having the good money to throw after bad, most people will make that decision, and we saw that. And mortgage credit models used to rely a lot on like labor market inputs and this and that and the other thing. And pretty much since the 2007 to 2012 cycle, the only feed that matters is home price appreciation in those models now. And you ask 10 mortgage credit investors, well, what's the main feed for the economy in your model? It's not labor market, it's not unemployment, it's just home price appreciation.
So you're implying, though, that all these MBS deals have to factor in climate in some capacity. Is it fair to assume they all are? Or
so getting it. You asked about getting into the weeds of the model. This is like an unknown liability, right? So there is a model here. There's a market model we're applying, and that takes into account some pretty factual things. What are they paying for insurance now? Then there's a whole bunch of uncertain things. And the key ones that go into the model are, what will they have to be paying for insurance in the very near term when the insurance gap closes? Again, once all these pricing refreshes that are underway are complete. And then secondarily, like I said, the other thing that matters to a buyer is what's going to happen to those costs in the future. So those are the three key inputs. What are people paying for liability protection now? Or what are people paying as a liability for protection now? For each hazard, wildfire and flood are what we're focused on for a bunch of reasons. And how much will they be paying for that in the very near term? And then how much is that likely to change in the future? And that's what drives our home price depreciation scenarios that can be applied in a credit modeling approach. So that's our basic model. Most of the rest of it from there is kind of common mortgage credit analysis sort of know-how. So, if you know what the home price is going to do, again, you know what the default rate is roughly going to look like. If you know what the home price is going to do, you know what and rates are going to do, you know what prepayments are going to look like. So that gets passed through. To your other question about are the markets, how does that get priced into a securitization? I would say not at all. Not at all. And I talked to all the credit rating agencies and things, and they just have the exact same requirement that all lenders have, which is you got to have insurance, and you got to be able to show you can pay for that insurance for 1 year while I give you this 30-year mortgage. So that's the big misconception. That's just not priced. I mean, so I think people are starting to worry now that they're starting to see certain counties in Florida falling at 10% a year, like Lee County, that was kind of the top of our top 20 charts when we started researching or doing these system level impact assessments in 2021. Now they're starting to say, oh, what might that look like? And now our way of framing scenarios, guardrails for where what's already happening ends up is important to folks. But how do securitization enhancements get determined? It's by credit rating agencies, and they are not at the front of the line in terms of integrating this stuff yet.
What makes me want to bring in a paper that was written by a researcher. His name is Matthew Kahn. I assume you might not have read his paper, but I'm assuming you've heard of him. He's actually talked about you before, so
I know him quite well.
Okay.
And I love him and Amin. Right, have written a lot of the best.
They're fantastic, and one of their papers focuses on basically diversification and. Although it's simplistic, I mean, from as you're saying that no one's really pricing these climate risks in, Matthew and Amin basically say, well, if you at least price it in through diversification, you won't see as much of an impact from cash flows, which makes sense, right? If your portfolio is more diversified, you're not going to see as big of a hit if your entire portfolio is burnt to the ground, which again makes a lot of sense. But is that incentivizing the wrong action where they could price it in better? They, as in the MBS people, could price it in better, or is really right now diversification and just thinking climate change as in we need to transfer risk on a bigger scale than we currently are, a better way to look at it than getting into the nitty-gritty? So
I have read the paper. Matthew and Amin, and we have many good conversations. And there's a little bit of a missing concept in that paper, and I'll just I'll throw it out there. Again, all of this stuff is uncertain, but I would argue that most of the inputs for that analysis are based on empirical evidence of how markets have been impacted by prior disaster events. And so what it looks like, I mean, this is what they're basically describing is why securitization exists, why it's efficiency. It's like insurance. It's like you gather a bunch of things together and you pool them and you carve up the risk. And Then someone who's very, very sophisticated can really play in that like double B tranche or the equity tranche and really understand like every dollar of cash flow and where it's coming from. And then the rest of the people in the pool don't have to worry about it because the diversification and the subordination protects them at a given sort of rating category. So that's how securitization works. And in the context of historical disaster events, big events like Harvey, Irma, Louise, right? Still only impacted 5 or 6% of the collateral. And the impact in any given deal, and right, because it's the whole country, and it was only 5-6% of the country that gets hit by any given hurricane like that. And the result was that there weren't a lot of mortgage losses, right? There were defaults, big delinquency spikes, but again, the property values didn't go down. And 2 years later, most of the people were either current again or had been bailed out by a speculator who comes and pays off the loan for them, gets the property at a nice discount, fixes the damages, and moves on. So that's history. What we're talking about now is, call it 20% of collateral facing a whole new scrutiny around its long-term utility, right? All at once. So that's a very, very different scenario than the empirical estimates that went into the sufficiency of the modern securitization in their paper. So I've actually talked to Amin about somehow incorporating that. So they have a foreclosure haircut in the event of a default. It's one of the typical things in a credit model. And what I want him to try would be to put in an additional value haircut on that foreclosure event that has to do with addressing the long-term utility issue. And I could either feed those to him, give him the 120,000 micro market scenario shocks that we have, and he could just feed them right in that way, and rerun the analysis and see what he gets. It's not going to look like everything's hunky dory.
How do you determine the time frame on the analysis of that scale?
Yeah, again, it's the time frame. I think this is what's key and why this is taking so long, sort of, for credit markets to integrate these problems in their pricing, in securitization structures, in underwriting and rates, is because, again, historically, nothing's really happened in terms of losses after hazard events. But the issue isn't about the hazard events. It's about these changing property utility. So that's one of the problems. The other big problem is everyone's used to thinking about climate change as this like 2100, this will happen, and sea level rise by 2050, this, that, and the other thing. And everyone's like, yeah, sure, the mortgage is 30 years long, but a lot can happen in 30 years, and I'm not that worried about it. I think we're seeing something very different evolve, and fully expected this to happen. And actually, this is more based on efficient market hypothesis, is once the market knows those long-term liabilities, it's only going to take a few years to price all that in. So that's really, so I actually think we're sort of 3 years into and maybe an 8-year kind of repricing cycle for this particular idiosyncratic risk. An idiosyncratic risk impacting maybe 20% of properties across the U.S. So idiosyncratic starts to feel a little different in that world.
And you're talking about just a standard approach for everyone underwriting the risk of climate change, correct? On the 3-year to 8-year horizon.
Yeah, I'm mostly thinking about the property value impacts.
Exactly.
So, whether the insurance is fully being charged at that point, and you've got all buyers are cash buyers, cash buyers who are pricing in, however it is, and mostly the the values being reflected in enough markets, that the true value.
So when you're underwriting, are there different risk categories for the different climate disasters? Fires, tornadoes, floods. Do you see one that's more perilous than others?
Yeah, we actually haven't even tackled hail and tornadoes yet, even though there is some indication that those outcomes are getting worse as a result of warming temperatures. It's pretty early in terms of like people's understanding of that. So far we've really just been describing wildfire and flood, and there's a couple reasons why. Again, the market issue that we're focused on, the thing that we actually see causing problems for people and then also for markets because of all the defaulting mortgages, that has to do with a repricing of risk that's mispriced, right? Everyone has wind insurance, right? And it's been privately priced for a very long time. Arguably, that's a decently efficient market. Flood, on the other hand, hasn't really been reevaluated from its pricing and adequacy since the NFIP was created in 1968, right? So that's been a very, very long kind of buildup and misperception about what it should cost to protect against flood. And that system is just like, it broke because, fatigue. At some point, there's too much borrowing from the Treasury to ignore it. So that's a big one that's happening. Wildfire, again, I think the models really missed the mark on, and I've seen this looking at climate conditioned wildfire models. They still don't have a great mechanism for explaining the massive increase in wildfire damages starting in 2015 and on, relative to the amount of warming that we saw. So that's still sort of up in the air. So there's a lot of scientific stuff on that, but the hazard models are just like, they're still trying to figure it out. I think there's the flooding risks. There's a whole bunch of different types of flooding. Some are better priced than others. Certainly inland flooding is lagging. And then there's a whole bunch of nuanced stuff around flooding as to whether someone knows they have flood risk or not and is being charged for flood protection or not because of the whole FEMA map thing with the special flood hazard areas, this thing called the mandatory purchase requirement. All of these things are sort of getting upgraded and going away. But that's the thing, is that gap is closing very rapidly for flood and for wildfire. There may be a gap for tornadoes and hail, but haven't really seen it. I think also things like water scarcity, heating, like we haven't even addressed all of those other impacts on economic activity and migration. It's really, those are just the flood and the wildfire. It's like, those are dollars that are on the income statement of the property. And those are changing very rapidly right now. Like that is happening. And again, you can tie actual listings performance and transaction performance to those changes going on in the markets right now. So, there's a lot the governments can do to intervene. Like they can't change the laws of physics, right? And those two systems are in trouble.
So on an industry scale, do you see, and since really COVID, and I know DeltaTerra was started in 2019, but really there's been kind of this onslaught of new firms providing some type of data on climate, or whether they're investors tangentially related to climate disasters. Do you see the industry moving towards siloing in terms of some capacity, whether that be the perils that we just talked about, or in terms of just being CMBS? Or how do you see the industry shaking for climate data and risk analysis.
I think the industry's attention from this point going forward is going to be driven by realized risk and losses. And again, I think that's mainly a function of declining affordability because of insurance hikes and what that's doing to asset values in the most impacted markets. So that I think the thing is like you mentioned, CMBS. Commercial properties are generally less likely to be in harm's way. So there's a couple things about that. One is that you're just, and then I'll get back to COVID too, because COVID was interesting in what it did with this theme. It made it so much worse, just because there was, anyway, I'll get back to that. But first going commercials, they're less likely to be next to a water view, right? You're more likely to have a single family home with a water view than an office property. And same with the wild urban interface. So that place that's really susceptible to wildfire risk, that's in between the woods and some major urban center, that tends to be the most exposed. So both of those tend to be more occupied than like the share of the market by single family homes. So bigger problem for single family. Single family is a bigger market. The other thing is just the number of floors. So if you have a 50-story multifamily building next to a single family property that's 2 floors, the flood risk as a percent of the built value is much higher for the single family property. So it's like you do these stresses, and when I mentioned about 20% of single family homes, and it's slightly less than that, to be honest, 17, 18, have one of these 2 major liability problems. It's only about 6% of commercial properties, and the problem itself is lower. So I would say it's a single family market problem. The more if you think about the securitized credit markets, there's, call it 3 majors. There's CMBS, which we talked about. There are some pockets of CMBS which are very, very exposed because oftentimes you can have a highly rated bond from what's called a single asset, single borrower deal. And there's just one property. And basically the value of that property is carved up based on seniority. Those, it doesn't matter. If you have one of these dramatic kind of climate value resets, that could hit the AA or even the AAA on one of those bonds. Most conduit CMBS is protected by credit enhancement and diversification. So that's CMBS. The other 2 big markets for mortgage credit are non-agency residential mortgage-backed securities. And there's kind of 2 major components of that these days. There's jumbo prime, and that's always been around. And then there's this thing called non-qualified mortgages. So neither of those types of mortgages is sellable to an agency. And so they either live on a bank's balance sheet, or they go into one of these 2 types of new non-agency RMBS securitizations. So that's that market. The largest part of the market by far is agency guaranteed mortgages. And there is a new mortgage credit market that supports the agency system called credit risk transfer, CRT. That market was created in 2012 when the regulator for Fannie Mae and Freddie Mac realized that it was going to be much harder than they ever thought to reprivatize those entities after putting them into into conservatorship in 2008 when they went bankrupt. So those were public entities. They're guaranteeing. So Fannie and Freddie guarantee $13 trillion in U.S. conforming mortgages. Obviously, I think of them as the biggest real estate investor on the planet, because what they do is they buy the mortgages, they sell MBS securities that can trade kind of like government bonds. But the reason they can trade like government bonds is because they guarantee the credit risk. So if any of those loans defaults, they have to write a check to the mortgage bond holders. And so that they're basically just massive levered credit conduits. And FHFA said, oh gosh, that used to be the problem for their equity investors who lost all their money on subprime. Now it's a problem for the US taxpayer. And so in 2012, the FHFA went to them and said, you guys have to do something about this. You have to create a new offset structure. And they created this credit risk transfer market, which it basically puts bondholders in a first line of defense position as losses occur on those loans. And then they keep the sort of the senior part and adequate risk retention, but they sell off. Now there's 350 of those bonds outstanding. It's like 60 billion in face, but those are standing as protection against 2.5 trillion in guaranteed mortgages. So that's actually where the risk is concentrated from my perspective. And not surprisingly, they're some of the first to kind of start looking at it. Those that market in particular is sensitive because the pools are so diversified that, like, if California and the bonds are at the bottom of the capital structure. So California has a problem, they're in trouble. Florida has a problem, they're in trouble. Massachusetts has a problem, they're in trouble. New York has, so it's, that is the most exposed part of the market probably. So we'll see if bond buyers in that market start to put pressure on Fannie and Freddie. It's kind of a funky market because there's 2 sellers and like 500 buyers. So there's not a lot of incentive for the buyers who are supposed to be going to Fannie and say, don't put that risk in the portfolio. They're just like, I just want more bonds. So it's a little tricky, that market. But anyways, I think that's where the risks are pretty concentrated.
So we're almost at time. I have probably a plethora of questions from that. But really, for our listeners, for my own curiosity, what's really next in this climate? And I know you talked about the 8-year repricing, and that seems to be the bulk of what's next. But for DeltaTerra, for really the industry, aside from the repricing, what is next, do you think, that's going to have an impact?
Yeah, I think that the biggest things will have to do with the credit markets. And I think that first specter that you mentioned of, okay, if I can't get insurance, I can't get a mortgage, like, that creates a big problem for markets. I think that's what's coming next. There's a couple very specific pathways that could emerge. I think the key things to watch are this concept of the mandatory purchase requirement for flood insurance. So right now, you only have to get flood insurance if you're in a FEMA-defined special flood hazard area, and only if you're getting a mortgage. Florida is actually the first to move on this, ironically. At the end of 2022, after Hurricane Ian, they had a bunch of insurance failures in the state, and they passed a whole new set of laws. And the most impactful one from my perspective was they said, anyone who ends up having to get insurance from the state insurer of last resort called Citizens, they have to get a flood insurance policy first. And that's whether they're in a special flood hazard area, that's whether they got a mortgage or not. It's just like a hello, liability to the Fed and cost to the homeowner. And I think that was a much bigger change that's going to happen system-wide at some point. At some point, people are going to question the requirement for only $250,000 of building cost coverage, which is where NFIP maxes out, and that's all that's required by lenders. So again, all of this has to do with lenders saying, oh, geez, these things are really a problem. We better do something about it. Oh, let's expand the mandatory purchase requirement. Let's allow more risk-based pricing in these markets. Let's encourage resiliency and price it out that way for everyone to see. So all of those things, I think that's what's coming. I mean, we think that these markets, when all is said and done, will be down. The typical high-risk market will be down 25% correction in like a base case. I mean, you take like it's a market where we have an even bigger correction expected. It's like Punta Gorda, Florida, was up 70% between 2000 and 2023. So it's you're only giving back like half of the COVID rally, right? In that scenario. I mean, a market like that, we actually expect to be down quite a bit more. And where those things go is reliant on, again, this expectation that markets adopt around the long-term utility. Unfortunately, we've got two scenarios, and one is kind of benchmarked to Paris Accord, global coordinated action, greenhouse gas reductions, and basically a topping out of temperature of warming at about 2 degrees 30 years from in the future. I mean, our other scenario is unchecked greenhouse gas emissions, 3.5, 4, 5 degrees. I mean, those are like kind of Armageddon looking scenarios when you actually look at the science, but just pricing it out in terms of dollars to support real estate liability, that takes those market losses from, a market that would be down 25% is down 35, 40%, if that's what people start worrying about. So I think that's kind of what's next. And of course, so there's big things afoot in the mortgage credit system, some around climate. So for instance, the FHFA, the regulator for Fannie, Freddie, and the federal home loan banks, they had issued advisory bulletins last year to the federal home loan banks first, and then to Fannie and Freddie. And those were just rescinded last week. And they basically spelled out, the path forward for a nice orderly adjustment around climate risk, and they just pulled it back. So it's likely going to be less orderly than we would have expected. And I think the other thing would be Fannie and Freddie privatization could change a lot. So there's a bunch of big things that could happen just in the systems.
I think we might have to do a part 2 because I have so much to talk about. Unfortunately, we're at time. I mean, I can't thank you enough for all your wise words and all the sage advice, great anecdotes. It's incredible.
Great. Well, really, really happy to help, and I hope some MIT real estate students and other enthusiasts get to benefit from the chat.
Absolutely. Dave is CEO and founder of DeltaTerra Capital. The paper we were referencing earlier is called Adaption Using Financial Markets, Climate Risk, Diversification Through Securitization. Thank you, everyone, for listening.
Thanks to our listeners for tuning into another edition of Meet the Visionaries podcast. And please remember to stay tuned for future episodes by subscribing to our podcast or follow us on social media by visiting cre.mit.edu to learn more. Until next time, take care, listeners.